During the meeting, the company will summarize the financial results for the first half of 2025. Please note that the meeting is being recorded and will be posted on the company's corporate website anytime soon. If you don't allow for the recording, please disconnect. We kindly ask you to mute your microphones and turn off your cameras, and please send your questions via chat. After the presentation, the company will try to answer them. And Paweł, the floor is yours.
Thank you so much. Dzień dobry, good afternoon, bonjour. Today we will give a very short update about the company proceeds and also the results of the Q2, as well as the summary of first half of the year. I'll be doing that along with Łukasz. We have a hard stop at 2 p.m. so we will try to finish soon enough to answer the questions that, as always, we expect in a significant quantity. So let's go through a quick part of my update first, and then we'll spend more time on financials, as there's more data points that Łukasz will be able to share. Sure. Okay. For those of you that are not familiar with our company, very briefly, we are a vendor of COTS. It's an analytical platform that is aimed at connecting different data sets and building on top of that knowledge graph, company-wide knowledge graph. This is something that is enabled by our graph hybrid backend, and a number of patents have been issued for the DataWalk company in the US. And on top of these patents, we have built a very unique architecture that enables us to offer off-the-shelf open platform that serves as an alternative to Palantir with a different business model. Now, this kind of technologies are very important for making sure that you connect big volumes of data in order to leverage those data points for different data sets for different types of analytical workflows, including AI. AI is highly dependent on ability to feed those models with the data sets, and specifically knowledge graph are considered to be a critical element of AI stack because of not only the capability to integrate the data, but also feed those AI models in a way that they can efficiently compute them. And this is something that not only we, but also many other experts in the field have recognized, such as Gartner. So let's move on. Speaking about Gartner, the necessity of having a knowledge graph enablement for your corporate data has been already identified several years ago, and more and more companies were investing in that area. Still, it is a niche. Very few banks, as far as I know, just several, have built the enterprise-wide ontology that enables to serve as a knowledge graph. And still we have significant challenges with the technologies that have been deployed to do that, mostly in terms of scaling, but also in terms of processing different type of operations other than knowledge graph not natively do, which is graph. But still, at this point of knowledge graphs and graph technologies market adoption, where we are in what is called a slope of enlightenment, meaning that we're behind the hype. Graph technologies are no longer this new thing that will save the world, and suddenly they are not really delivering on the promises, but they are already being implemented and starting to deliver significant ROIs. If you read the reports by, for instance, Forrester, that shows a typical Palantir project with a cost of $80 million, it actually delivers a value of over $200 million. So the ROI, return on investment, in that kind of technologies is very significant, and it is the first moment where we are seeing a productive use of such technology in the field. We have the same data points from our customers, and customers like ours can save significant amounts of money on just curbing the fraud, but also there are a number of other adoptions where knowledge graphs are very important. One of these applications is enabling corporate-wide AI. We've been offering our customers deployment of these machine learning models on our neural networks for years. First deployment was, I think, in 2017 with one of our early test customers. And the reason is very simple. Those neural networks or machine learning models are highly dependent on the data that you feed to them. And since we were able to integrate different silos and break them and enable knowledge graph that can efficiently compute those data points, we were selected by these customers to deploy these models. And over time, we added this as a core functionality of our front end that you can install any model on top of ours, wherever this model is. If you have it in a Python library, in R, or you maybe would like to use from one of our predefined model creators, fine, you can do that. All that is possible. And then the computation of the model's mathematics, which is the hardest part, is done in our engine, and it's very efficient. So we can combine customer best analytical models and leverage our strengths in computing of course feeding it with all the data that is coming from different data points. Now, this has been the case for many years. Recently, we've seen an adoption of LLMs, and this is something that and Gen AI that is becoming an area of significant interest of our enterprises. Some of you might have seen a recent report that shows that 95% of LLMs adoption in enterprises is a failure. What it means that they've spent some money, they tried to adopt LLM into their daily operations, and it doesn't work. Why doesn't it work? It's because it hallucinates. It's very hard to connect it to the data sets. It's very hard to operationalize the effects of such analytics. And that's exactly what our technology is built for. If you're interested in that area, you can go to our website and find one of our papers that shows that we can reduce or eliminate hallucinations by anchoring the LLM on the knowledge graph. And this is something that we have tested last year. We have the benchmark and some analytics around this already published. And we've been working on enabling this capability to the customers in a productive way, not to ride the hype, but to efficiently enable them to deploy those on their into their daily operations. And this is something that is one of the points that we'll be shortly discussing today. Some of you might be familiar with what's called MCP. MCP is sort of a standard. It's becoming a standard, but when we started working on it, it wasn't a standard even. This is a sort of an API or a layer that enables different LLM models, regardless of whether this is ChatGPT, Gemini, Claude, Llama, whatever, to connect to, I would say, a source of data and efficiently query that source of data. So we used MCP architecture that we implemented in our product and tested internally in order to enable our customers to use any LLM model they have and leverage the capabilities of the big volumes of data that sit in our system, along with the knowledge graph capability to eliminate the hallucinations, along with the platform's capability to operationalize the results of such system usage. And this is something that we have already tested and demonstrated to a number of customers. Meanwhile, while we were doing this, it has been confirmed that the MCP architecture is becoming a sort of a de facto standard in the market. And thanks to this approach, we are able now to go to our first customers, which we are starting to do in September. These will be just several customers that we already have that want to test these LLMs or agentic AI agents deployed via these LLMs in their own day-to-day workflows, And so this is something that we will efficiently test with them, with those beta customers in Q4 of 2025. And the plan is that we will enable them to buy these licenses as a new license part number in our offer since beginning of 2026. And other customers will also, of course, be able to buy it, but the beta testers will have a special offer for that. This will add to our capacity to upsell, but also this is a significant value because a customer could leverage the platform and the data that they sit on and use whatever LLMs, whatever machine learning models or GenAI technologies they have, and not be forced to adopt something that we are used to. We will adapt via our architecture to whatever they have. It has always been our philosophy that this platform is built as off-the-shelf, highly configurable, with no-code, low-code capabilities to adapt to anything that is within the customer space, so they can put any data in, any data out. That's a business model that we built around that capability of technology, and this is something that we are now expanding to this AI field, and we are expecting it's going to be a driver both of value for the customers, but also revenue for us. Last but not least, we are observing a trend on the market which is connected with decoupling or this defense awakening. I think it doesn't need explanation to any of you. We've been recently publishing more and more papers or materials. You can see some of the examples on the website, and this is a conscious campaign that is fueled by the fact that some of these people, some of these agencies, institutions, ministries of defense came to us and are interested in a partnership, and we see much more of that this year than we ever saw. This summer was particularly busy with a number of pre-sales and engagements with such customers. You also saw anonymous customer purchasing our license this August, and this is an example of this national defense or national security case from Western Europe that in this case is just another point that proves that we should continue positioning for this market opportunity, and that will be something that you should be seeing in our content and materials, and also some stock reports in the coming months or quarters. So that's it. Let me handle over to
Okay, thank you, Paweł. Well, right now it's a tough part. I mean, this technology is so interesting, but right now switching to the numbers might be a little bit boring. But let me do the best of what I can to explain and actually transfer and explain some numbers which we just published. Hopefully, some of you have already a chance to review, if not fully the whole financial package. It's lengthy, but a key takeaway. So let me guide you through the most significant numbers and what will be a focus point of this year, but also the hopefully next period. So if we might summary the first six months of 2025, I would actually say that it's a strong execution, proven by triple-digit growth. I mean, revenue growth year over year comparing to the last 6 months of 2024, it's 118%, which is great. Actually, the revenue number which we achieved in the first half of 2025 almost is equal to the result for the full year of 2024. So it's like a 23 million zloty for the 6 months. If we look at how we are doing in the trailing 12 months period, it's still super growth, 62%. It's meeting somehow our expectation, but far below our ambitions. You have heard many times from us that we are positioned for hyper growth. Hyper growth for us means 70% plus on the year over year. basis. We are still not giving up, pushing hard to deliver that 70% growth minimum in 2025. What is quite unique and quite comfortable in terms of the balance sheet is our cash runway. It's a combination of two factors. First of all, I would like to once again pay a credit and once again make a big thank you for all the investors who decided to successfully take over the new shares, which we successfully closed in May this year. And that together with a significant revenue growth and also the customer acquisition, it creates for us that right now we do have 66 million zloty of cash equivalents. With that, we've coupled with several million of short-term accounts receivables. Gives us a quite comfortable situation looking for in the very optimistic way for further growth. So let me digest a little bit on this cash position. Obviously, for the companies like us in the early startup or scaling phase, the cash is the king. So the 77 million zloty in cash and short-term equivalents of cash is giving us 42 months runway. And what we are going to do with that money is actually definitely invest, still based on the triggers, but invest in the mainly go-to-market teams to actually fuel our growth further, to make it in the responsible way, to deliver results looking in this hyper growth scenario. Why we do that and when we will invest and make a laser focus on growing go-to-market team is to actually keep momentum and keep revenue growth. I mean, we observe this accelerating commercial adoption, and if we digest or break down our revenue numbers for the first 6 months of 2025, we see that all the growth is coming from the commercial expansion, in particular banking sector, which is right now starts to be our leading in our portfolio. Commercial expansion is right now, we are growing year over year in 175% in this sector. If we look primarily on banking sector, this is a super high growth of 250%. Right now, commercial business makes 72% of our trailing 12-month revenue. And banking itself, with actually 4 or 5 customers from that sector, is actually composing 65% of our trailing 12 months revenue, which might be interpreted as a very good thing, because as we announced or actually informed you a couple of quarters ago, financial sector in primary, especially with the banking and top leading banking, this is the best customers for us. I mean, the high level of, let's say, absorption of technology, understanding of the technology, sometimes better than us. So some of those accounts, we treat them as a completely lighthouse accounts, because not only we are making money, but we are learning a lot how we can actually make our technology better, how we are building together additional use case, which then can be pasted and copied to the other customers. So again, I mean, even though we are super proud with 118% growth, I mean, if we make it a little bit clearer, look at the last 12 months, it's still 60-ish, and we are pushing hard to make it happen. But foundation, especially in terms of already installed base and the cash position, our healthiness of our balance sheet is really positioning our strong for the next quarters and next periods. So what else is interesting in terms of our revenue? And so the revenue growth is not only coming by the new wins, but it's also coming from the land and expand and our stickiness, so customer and platform stickiness. So 30% of annual recurring revenue growth is something which we are super proud of, especially that it's coming also, the majority of that growth is coming from the net dollar retention. So how much extra money we can gain from the installed customers which are already with us for the certain amount of time, predominantly for the 2 or 3 years. So this is actually also some kind of the proof that not only they are happy, they are loyal, but they recognize the value, this ROI which Pavel described. For some of them is so evident that despite the fact that we are raising the prices, capturing the more value from our solution, because right now we are 100% sure that what kind of value it delivers to our customer, we are still willing to pay. What is also the other KPI looking at our annual recurring revenue, it's worth to mention, is that on average per customer, our annual recurring revenue is growing 43%. Yes, you might look at our financial report and say that, okay, we were like a 40-ish customer company. Right now it's in the range of 30-ish. So it means that we actually lost 12 customers, but we can say it's not really a loss. It's some kind of a conscious decision of redirection and not to actually, we just let those customers go because of the very little potential for us to grow and also very little value perception which they have to our solution, meaning that we were stuck with those customers in terms of expansion and also the price point which we asked at certain moment. It was too high for them. But anyway, even without that churn, our annual average recurring revenue is still growing. It's like roughly 370,000 zloty per customer on average. We obviously in top 10, we have customers which are paying far more than 100K per year for the just maintenance and support. I think the top leading 3 customers, it's significantly above $200,000 of annual maintenance fee. What is also worth to mention that right now, 100% of our annual recurring revenue is composed only of these support services. So because some of you who participate in our Q1 earnings calls when I presented the revenue recognition model, understand that right now, even though we are start to selling term licenses, the revenue model is that portion of licenses recognized upfront. It changed a little bit from a cash perspective because cash flow wise, I mean, some of the cash will be much more recurring, much more than this 11 million. But to close on that, new customer acquisition together with the customer stickiness, it's actually giving us a good solid result in terms of first 6 months of 2025. So also it has a significant impact on our product mix. Obviously right now for the first 6 months and also for close to the trailing 12 months, our product mix is very close to the, I would say, ideal for a company like us, meaning the commercial off the shelf. When the license components constitutes roughly 70% of the products mix, the 25-30% is made of support, and small portion, less than 10%, is tied with professional fees. Why this mix is ideal? It's because what is the gross margin representing by each of the products. So on license, our company makes a gross margin in the range of 85-90% plus. On the support, it's 50% plus and growing. And profits, we are still negative because we somehow subsidize our land mission when the profits are, we capture only the cost due to the fact that we are still hiring a super skilled and high salary level of technicians and software and solution engineers. Sometimes we are giving or delivering the professional service at cost, sometimes at loss, especially when we are talking about proof of concepts. When there is a fixed fee, we know that our investment will be much higher than just a fee for the service. However, this is a long-term investment in that customer and this particular business. So coming back to the, I would say on the right side, looking at the total gross margin, that's how the mix is driving the overall average gross margin of our overall portfolio. And you see that, I mean, when first half of 2024 was relatively poor in terms of mix, because the product license part was, if I remember well, like 30%. And the overall margin was 22% gross margin on the product. Right now, with that shift is actually soaring to 70% with the potential for further growth. So before we go and understand the whole P&L, I think that some of you who numbers are just numbers, so we might get a super puzzle when the equation is that the company is 23 million zloty of revenue and 83 million of costs, so 60 million zloty of EBIT loss. It looks terrifying. I fully agree. And you might say, why this guy who is talking to me and is actually calling himself a CFO is talking about strong execution? So let's break down this equation into the slightly almost the same numbers, but giving a little bit more detail. And for the time being, I would say 23, obviously green, it's a revenue, 28 and 55, it's a red, it's a equivalent of our cost. So let's focus right now on this 55, because I think it's worth to pause here and once again go through some details. I mean, all the juicy and all the description of our share-based program you can find in our financial statement. I think it's overall, it's like a 10 pages long description, but just to once again give a short summary, what is it, how it's interactive with our P&L, and fundamental question, quite a philosophical one, is it rather an assets or liability from the company? Talking about technicality and the financial statement is definitely a liability and P&L. But first and foremost, we need to understand that our share-based payment program is actually with a double trigger vesting mechanism, which means that not only the individual vesting conditions set for individual contributors or participants needs to be met, but on top of that, in order to share vest or restricted stock units exercise, the takeover control of the company needs to happen. So this is the second, actually, the trigger, which actually will launch and start the program to be being actually live and monetized. So the second very important point to understand our share-based payment program is that 63% of that is via restricted stock units, which are not equity instruments. They will be a cash settled instruments, which means that I not, when second trigger will happen, the program will be actually materializing, then this RSU will not cause any dilution of existing shareholders. And last but not least is the implication of our financial statement. So the equity settled, so these 570,000 units of shares of the stock options, how they react in our financial statement. So they are actually, the value is tied to the moment when the grant date was. So it can be different on average. If I calculate the average grant date price or the fair value of that kind of instrument is in the range of 100 zloty right now. And when time goes, the stock valuation fluctuates, it doesn't not change. So it has some impact on our financial statement, but not as fundamental as RSUs. RSUs, which will be settled in cash, they are from the International Financial Reporting Standard Framework, are treated like a liability. Liability requires mark-to-market obligation in terms of evaluation. So every single balance sheet date, we need to revalue both liability to existing price, stock price of our company. For the first half of 2025, this remeasurement of revaluation results in 51 million zloty of extra cost, actually increase of our liability, which needs to be reflected in our P&L. So even though we have not given at that time any additional share-based payment instruments, the valuation of something which we already delivered or granted a couple of years ago is creating this kind of liability increase, which has a result in our P&L. So financially, we might say it's a super high burden to carry. But if we look really from a strategic standpoint, and here is my answer to that question, from a strategical standpoint, it's definitely an asset, because that tool or that instrument assures that we can still retain and hire really world-class talents. Without that, it will be super difficult. Right now, we are sitting in the luxury position that we can leverage on some other instruments because our balance sheet is healthy. But when we look back in 2019, 2022, when we were really at startup phase, that was the only thing or the only instrument which we can actually aggressively play to bring the high talent and retain the existing customer.
Yes, let me add two or maybe three data points from the market first. By the way, 63% are RSU based, but 30% of the rest is also similar mechanism. It's just indifferently financial. So long story short, nobody in DataWalk makes anything on this instrument until we are successfully being acquired, period.
Yes.
So
yes.
There is no cash cost. We've mentioned it a number of times, but it's sometimes forgotten that
till the moment when there will be a change of control, well described in our article of association and the guidelines or the rules of that program. And to make it happen, it still needs to be a public offer. So majority of shareholders need to give a consent because it needs to be a fair deal. And this fair deal needs to be for existing shareholders, the one who is going to take the control over the company, founders, and employees. So we are actually all packed together to happy ending.
That's one point. And by the way, this is very attractive to comparing to other employee stock option programs. If you look, I don't know, on Palantir stock option program or others, they are not as attractive to investors because they are about issuing shares and giving them to employees that later sell them on the market. And you can look up what were the values and how many zeros those values had for some of these programs for companies in our space. You can find companies which were startups of which executive teams sold $1 billion of shares in a given year. So that's not the case here. Nobody of us is making that move, and I and other founders never sold a single share. We only bought. That's one point. So this is very attractive for you as investors. Then the second point is, if you look on the size of this program comparing to the benchmarks, it is actually much lower than what you would see in any high-tech company in the Silicon Valley, or even some of these companies that are very, very large and still are treated as startups, but are listed already on NASDAQ or New York Stock Exchange. So the total value of our program in percent-wise comparing to equities, how many percent?
Total with RSUs?
Yes.
It will be like a 25-30%.
Yes. So and of that this is something that we started to use several years ago, and is supposed to last for several years. So it's just lower several percent per year. So for a company in our stage, it is considered very modest. And the second, maybe third thing here is that the distribution of that is very unique. In most cases, in most companies, this will be distributed to top managers, 5, 10, 15 people. Sometimes 2 VPs. In our case, it is much more socialist.
Well, it's 90% of our current staff, so 100-ish people are covered through the program.
Yes, and this is by design because we are building a highly motivated team that we will want us to go with us through many years of hard work. Many of these years already happened, so this is already reflected here, and there are many more to come. And this is something that is discriminating this program from the market standard programs, and we wanted to make sure that this is visible to you.
Certain part of that has been already, I would say, vested in terms, but it's also worth to mention that for those individuals or participants of that program who already vested, and that program, 85% of those guys are still within our active, I would say, workforce or part of our team. So with that, when we right now understand the effect of 51 million that is just revaluation, and it's actually, I would say, something which might be a provocative, but you already heard once from the CEO who is apologizing here for the company is making the positive net income, but it shows that our inability to spend cash and develop the company. I would say I will not cry if we will see this 51 million or 50 million again in second half, because it simply means that our stock grows by additional 50-60 zloty per share, which I think will make a smile on everybody's face.
That's right.
So to close the story on the operational expense breakdown, if you right now understand, when we are right now understand this, that 82 or 83 million zloty of the cost which we publish in P&L, if we carve out the share-based payment effect, we end up with 27.9, but better to say, round it up to 28 million of additional cost. What is worth to mention is some kind of a small revolution, which we did in terms of presenting our financial statement. So some of you may have already noticed that we start to publish our P&L through the functional cost. So not only we are providing you the cost by nature, which was actually the way how we present our P&L in the prior periods, so it's represented on this graph on the far right side, but also on the middle level you can understand the cost by function, which is super important. At least we believe so, because it represents not only where the money goes, I mean, to which type of expenditure, but in principle to which function, which will give you and also us understanding of how and where the resources of the company are allocated. So if we look at the cost of revenue is quite obvious. We somehow indirectly cover that through the talking about high margins. If we look at the still operating costs, is something which will be classified. We carve three main buckets, like a sales and marketing, research and development, and general and admin expenses. And you can see that right now, surprisingly, all of those three are quite similar. 6.7, 7 million on R&D, and almost 7 million on general and admin. And it's not typical spread of a hyper or the company which is hunger for hyper growth. And definitely that's a state of art. It's like a snapshot of what's happened in the last 6 months of 2025. But we can guarantee that when we look at the same numbers or the same layout of numbers in the next couple of quarters, the split of the expenses will be completely different, because we will start, as we already announced, we will start to invest carefully but steadily. We will start to invest in go-to-market, which ultimately will drive a sales and marketing and the cost of revenue higher, for example, comparing to a research and R&D and general and admin. What is also worth to mention is that on R&D, in April this year, we actually launched version 5.0 of our platform, which is right now quite mature. So we are actually moving from startup to scale up. So the investment on technology, which will be right now less important, not saying that it will be not important, it will be less important than scaling the business and growing with go-to-market go-to-market. So definitely the primary focus of us in the next couple of quarters will be invest carefully in this go-to-market, and hopefully smart investment bringing return of that investment will result in the solid, robust Rule of 40 performance. So you can see that apart from the thing that the costs are growing, you will see that the revenue will grow, hopefully with a very solid double-digit piece. And with that, we will be actually, hopefully, improving the value of the company. So with that, I think it's time to open the Q&A session. Thank you very much.
Thank you, Łukasz. Okay, I'll read those questions top down, and we'll answer all of the ones that we can answer. So, for instance, the first questions are about what caused the sales funnel to drop from Q1 to now, while total contract value rose only by $0.4 million. So this is something that is simply dependent on the trailing 12 months factor, because please bear in mind that in Q1 of 2024, we have secured a large TCV contract with Barclays, for instance, which was no longer in TCV calculations that we just reported because it's beyond 12 months. So the trailing 12 months does not include it. And whenever we sell something, it drops out of the funnel as well. So it will be natural that you will see some fluctuations quarter to quarter because we sold something, the TCV will grow. And if we have a base that went over 12 months, then the TCV might go down. Long story short, because the company is on an early stage and we only have a small batch of customers that are making those numbers, you will not see a statistical impact on a stabilization of this growth. There will be some quarters where some things go down, some quarters with a significant growth, and it's all because the company is right now selling to early customers, and any single contract can be a significant contract for the company. And just to give you an example, our typical contract right now starts at $1 million, and $1 million is more than this company would bring in 2 months last year. So this is just one contract, and we are actually also working on contracts which are several $1 million or $10+ million, and those are game changers at this stage. In the future, when we will have 20 customers like this and these contracts will be more frequent, then you will see more stabilization on the funnel. Now, there's another question about the federal agency that was reported in August, and I'll cover that. I cannot really tell about the project scope and the license scope. It's confidential, but I'll answer, maybe give you some context with the next questions that reflect to that. And there's also a question on revenue recognition. I think we had a very detailed session about the revenue recognition during last quarterly feedback. So I propose
and it's also very well described in our financial statements.
Yes.
So I think that, but to cut the long story short, in terms of a license revenue is recognized upfront in terms of support service and professional service based on the percentage of completion or based on the time flow of the service contract.
Yes. There's another question on the revenue in Q2. How much of it came from Barclays, Morgan, Amazon? All of them participated in Q2, but there's a reason why we don't report details of how much it is a part of arrangements with the customers that we don't publish simply. But yes, all of these were included in Q2 and more. So you will see some more details on us, but forgive us not that we're not going to share details of every single contract because it's against those contracts and it's against the company's interest as well, as it's our trade secret. Now, can we shed more light on the implementation by the key customers? Of course, we can have a longer discussion about each of them. In some of them, things are moving slower because they're hiring people, they don't have resources. We have one of our large customers where we lost a manager of a team that we were doing implementation of with, and his boss and his boss's boss. And this, of course, causes a significant distress to a project, and then it causes delays. And in other customer, we have a team that is looking at a significant pipeline of use cases. Different teams want to use DataWalk, and they are limited only to 5 people, and they would like to actually add another 10 to that team so they can deploy DataWalk for all of these use cases. But they are now hiring those additional souls. So there are some work in progress. Some contracts are moving faster than even we anticipated, and we are held back by corporate procedures, not by our implementation. We have one of the, two most recent contracts. One of them is the system is already in production, even if it's too early. And in another case, we have everything done. We're just waiting for the cybersecurity team approval so we can go live. We no longer have to do much implementation with the customer. We're now just pending the corporate approvals process. So that's something that shows that the speed of the technology that is higher than the corporate machine can actually cope with. As to a question, are you familiar with Silent 8 and explain DataWalk advantages over them? I'm sorry, I cannot explain to you the advantages because those are completely different products. I know company Silent 8. I'm keeping my fingers crossed for every company coming out of Europe or with European founders that's making a difference on a high-tech landscape. Silent 8 is a provider of a point solution. Very good, top class point solution that's for sanctions monitoring. And this is a solution that you can put into the corporate systems like a plug and play. It's a completely different value than DataWalk is providing, which is an enterprise-wide knowledge graph platform. And the difference is very big. We are being applied to the same use cases, but it's like comparing a ticket for a bus to buying a car. Both are transportation, but it's completely different thing. And I'm not discriminating the mass transport. I mean, buses and tickets for bus are very effective, very efficient, and they are. It's a great business to be in. Point solutions are making many companies into multi-billion-dollar businesses. It's just that their problem that they're solving is going to a customer and telling them, you don't know how to monitor sanctions, you don't know how to connect all those sanctions from different areas, and how to efficiently make sure that this customer and that customer is not bypassing them. Here's out-of-the-box solution. You can turn it on tomorrow. In case of DataWalk, it's a completely different play. We go to a customer and we say, okay, so you have hundreds of data sources or thousands, and you have 7 main data warehouses, and you have 30 different systems, and also thousands or hundreds of thousands of documents, and you want to put it all together and make sense of all that data. And by the way, that data is accessible to that team, but that data is not accessible to anybody. It's only held by this team. And this is a huge effort where a customer has to decide, okay, how do I manage my permissions? How do I get that data into DataWalk? How I make sure that DataWalk is secure from cybersecurity standpoint, because they will be holding all of our data. How do I make sure that the lineage between that data is confirmed? Those are non-technology related questions, but highly impacting our projects. And we have a technology that, unlike ours, enables creating such a knowledge graph and putting that data together in weeks. But then the customer, on top of that connected data and going through all these processes, has something that is a company-wide knowledge graph that he can use for different use cases. And I'll give an example of Ally Bank, which started with fraud detection, then said, okay, we're going to also do it for AML. And this is very different fraud detection that Point Solution would do. It's a company-wide fraud detection of all types of frauds and monitoring at every level. And then AML, very different thing. It's than just checking the sanctions list or just doing KYC or just doing this. It's a comprehensive process which has many endpoints. And then there's insider threat. Then there's entity resolution for instance, marketing applications. Different analytical workforce you can set up on top of that knowledge graph. Different business model. We are not in the same space, and it's hard to be compared. Although I am very happy that Silent is super successful with the solution. It's a good example of how people are making money in this space, and I keep my fingers crossed for them. You booked 3.3 million zlotys from support services into the second quarter. Is it certain that this is recurring in the upcoming quarters?
Yes. Absolutely. Absolutely. I mean, our annual recurring revenue right now in total, I mean, on the trailing 12 months is 11 million and growing.
Yes. There's a suggestion on investing in direct sales. That's exactly what we're doing. But keep in mind, this is in our report, that we don't want to invest without a reason and without applying those triggers. We are looking at investments always in a conjunction of external and internal triggers. At least for now, which means that we are very carefully looking at each salesperson recruitment in the context of have we got enough of pre-sales engineers to feed that person? Have all the other sales guys been given as much that they cannot take anymore? Have we got onboarding capacity for that person? Have we got leads that we can feed to that person? And we are also looking at the management capacity in these areas, and both middle and top management areas are points of our interest in terms of hiring and internal promotion. For instance, in terms of sales, we're going to add a VP of sales, head of the sales globally in the coming months, who will replace me in that role. And all those are prerequisites for making significant growth of the go-to-market teams. We're making that investments right now in Q3 and Q4 in order to anticipate and prepare for much more significant increase of our go-to-market team in 2026. How significant a milestone on the path towards securing an enterprise license was the contract with the European agency announced in August? How much the cooperation relationship with the customer developed since the pilot in 2024? Let me just say as much as I can, which is in this case, it is a very important milestone towards increasing footprint in this customer. This is a very important reference. We cannot tell more about this customer because we are now in the process of exactly expanding, and this is a process that requires a confidentiality. And this is an important milestone towards making that sale and the success together with this customer. So let me refrain from saying anything more and go to another question. Last time you mentioned there were 10 customers or projects in the funnel. What noteworthy developments have they taken place since then? Are you currently securing any interesting pilot implementations? Well, I could probably sit in another hour and give you a very short brief of what happened over the past 3 months. We are very engaged in pilot implementations with new customers. And please remember that the path of selling to a large account is such that initially we start talking, we do some sort of workshop, sometimes then a trial, sometimes a proof of value, a sort of a pilot. This is a process that can take several months, several quarters, and then they have their own budgeting and procurement cycle. So, and usually we are landing a first deal that will be not the target deal. So let's say the first deal will be $1 million a year, and then we are expanding to 2, 3, 4, 5, 6, or $10 million a year. That's the plan, and that's what we with these customers we're signing up for. So if we sign up a new logo right now, you should expect that most likely this logo is not a large revenue for us here. For us, I mean, it will be $1 million plus, but it doesn't mean that it's 6 or 10 from very beginning, although it might happen. And we are very engaged in number of pre-sales activities such as workshops, pilots, trials. Right now, this summer was specifically intensive in that area, mostly around what I mentioned, which is European Defense Awakening. And let me go to another question. There was a suggestion on salesperson. I think we already addressed it, that we want to expand our go-to-market. Another one about the revenue recognition, which I think we already covered. And there's a question, can we explain what are the revenue from professional service that we showed in today's financial report, which is 1.3 million zlotys, so $450,000 in first half of the 2025.
So it's basically a part of deployment. So whenever we make a contract which requires deployment, it's usually any first contract with the customer requires a deployment, so involvement of our solution and system engineers. That's part of the deal. So if we say the typical example will be a 10 million of TCV for the 5 years license, of which I would say 7 or 8 million dollars will be in license, and 1.5 will be in the deployment service. So that portion which we disclosed in the financial statement is based on the percentage of completion. So it might be that some part of revenue has been disclosed in Q4 as we started the year. We started the project right now continuously by the number of or completing the milestones or number of hours. If it's a time and material, we are recognizing that portion of revenue. In line also, the cost of revenue associated with this piece of product flows the same logic. So that's why you might see and it's quite obvious for our company and typical that for the professional service, there will be a tiny or negative margin on that.
Yes. Well, the market is unfortunately a little bit spoiled by other vendors who are lowering the prices of these services specifically in order to attract these customers. It's not always the case. We see that, for instance, when it comes to rates, for us right now, a typical rate will be anywhere between $1,600, $1,600 a day, up to $2,000 for a basic professional service. And we are seeing some companies which are charging $4,000 or $5,000 a day. We have also examples from the market where people are charging $2,000 an hour, but because there's also a lot of VC money in the companies that are offering advanced analytical solutions, these companies are offering those same services sometimes at $1,000 or $1,500 a day. And we are increasing our prices of services, and we are trying to charge at least cost plus to our customers. But in some cases, these customers say, but look, these guys did this pilot for free. These guys wanted only $50,000 for proof of concept that lasted 3 months. Why are you asking me to pay $150,000? Well, it's a hard play sometimes for a company that is not VC backed like us, and also that is such an early stage company like us. But we are aggressively increasing prices, not only of the license, but also of the services, and we will probably continue. So hopefully in the future, we will be able to at least have at least 0% plus margin on those.
But basically, we are also limiting, I think, since Q1 or Q2 of last year, we are limiting the number of free POCs.
Yes. So what level of growth we expecting in Q3? I think we cannot share this information. Please wait until the Q3 report. are we in Kielce next week, which is the large military trade conference. We actually limit ourselves and we don't go to these conferences, but in Kielce there will be a small team because we have a number of meetings with different customers which wanted us to come. So we are just going there not to present, we're just going there for the meetings, and a couple of our people will be there for many meetings, but only for one day because we're very busy. When will be the exit? What milestone do we think should be achieved to think about it? It's a different conversation question. I think we have to play pause on this one. And thank you for all the suggestions, and thank you for the other questions. And we're all looking forward to making sure that we bring you more contracts and more stock reports about those wins. And we're working on some large projects that one of them might come this year. We're also working on upsells to current customers and landing new customers that will become future large contracts. So because of that, we have to run and finish today's sessions without answering any more questions. I hope we answered most of them. Thank you very much.
Yes, the time is up. Thank you, gentlemen, for the interesting meeting. And also thanks to all participants for attending the meeting and submitting questions. I wish you all a pleasant afternoon. Goodbye. Thank you.
Bye.